to the Cultum Vita channel. Today on You Need to Start Now, we're going to continue our conversation about the foundation to financial freedom, specifically in talking about market volatility. And we're going to break it down into three aspects in reference to this. And we're going to first talk about how it's normal and how you can invest regularly into that. And then two, in reference to the large swings in volatility and what opportunity we can derive from that. And the last one is what you can do now in reference to diversification to lessen the volatility's effect on your portfolio or your investments. And to start, we're going to be talking about the market volatility and how it's normal. This means you have to figure out a way that you accept that it's just a part of the stock market or part of investing, that markets are going to go haywire or they're going to go up and down. It's like real estate or stocks. You see this in both. And you need to figure out how you can invest regularly into stocks or real estate, whatever it might be. And to talk about this further, I'm going to pass it over to Matt, considering this is his wheelhouse. Matt?
Yeah, thanks. I think before we get started, I think the first thing we need to say is that you cannot time the market. Don't try. It's not possible.
I tried.
Experts, it's just nothing you can do, okay? But yeah, market volatility is a normal facet of everyday living. You know, you can have extreme swings or you can have just normal everyday market swings. Within the market, there's also the opportunity to capitalize on those normal market volatilities. And what I mean by that is small cap stocks currently has a price to earning ratio of 16 to 1. The historic norm is 24 to 1. So that's an 8-point difference. Now, large cap currently is at 23, and the historical norms is at 18. So what does that mean to me, right? Basically, what that means is what this is telling me based off historical averages is that large caps are overvalued and small caps are undervalued. So what do? You take your percentage of large cap, you sell it, and then you buy the small cap. And what you're doing essentially at that point is you're buying small cap on sale, and while you're selling large cap that's been overvalued. And it's a good way to capitalize on the normal aspects of market volatility.
Great. I mean, it's a good example in reference to market volatility being in your favor. It doesn't have to be seen as bad. Now, again, this is assuming you figured out how to invest, and that's because that's the most important thing. You need to be investing, and whatever mindset or whatever you need to know and figure out to get there, that's what you want to do. But within market volatility, there are lots of opportunity there. Now, there's also large opportunity, and that's more relevant to big swings. When the market crashes and there's bad things happen, the market will swing very largely in one way or another, typically up and then down. And so when that happens, there's huge opportunity. And for me, it reminds me of COVID and how it swung. Now, a little background is in 2008, when the crisis happened, I had just recently graduated from college. And unfortunately, in that situation, the best way I can surmise it is I felt like a kid who adored candy, loved candy, and all the candy stores said 90% off all candy, and I had no money. And so it was the worst thing ever. And I was so frustrated and just jealous of people who could make investments. Now, fast forward to COVID, and the markets crash. And so I go and I take any extra funds, emergency funds allocated for something else. And I take everything I can and accumulate a large cash money and move that into my investment account. And unfortunately, I get to the point of making the investment and I just can't pull this trigger. As we talked about, scarcity mentality is difficult to overcome. But this is also where another element we talked about, and that's partnerships, comes in. Because I went to my wife and I told her, hey, this is what I want to do. And she was like, what? Why? And I explained to her, and she was like, okay, let's do it. And I was like, are you sure? And she's like, yeah. And I was like, how can you be so sure? And she's like, for all the reasons you said. And I was like, oh, okay. And we invested, and it was good. And it brings me to the idea of, like, I felt like I was on a paraglide about to jump, and I trained and I got certified and did everything, but I just couldn't get myself to jump. And my wife was very kind to pushed me.
Just need that little nudge.
Yeah, it pushed me off the cliff because I couldn't do it. And together, we were to take advantage of this huge opportunity in the markets and how they fluctuated at that time. And but it's worth mentioning the risk because we didn't know what that meant at the time. We didn't know what it could mean for the future, and there's always risk involved. And the important thing is to do it consciously and to make calculated risks. And for us, it proved very well because very quickly the markets swung back afterwards. Now, the last one we're going to talk about is diversification. Now, diversification is going to be very important because within a micro perspective like stocks, you can diversify. I mean, you can do that with other things, but we're going to talk about specifically in our example with diversification within stocks. And for that, I'm going to pass it over back to Matt.
Yeah, I think it's important to also highlight the fact that through your various life cycles, you're going to want to have a different allocation. Most people are going to want to have a different allocation of stocks versus bonds. So what does that look like, right? Let's say you're 20 to 40, you're going to be in the growth phase. 40 to 60 is going to be in the maintenance phase, and 60 and above, you want to be in the phase where you're now using that money, right? So you're begin depleting it. And when there's extreme market volatility, you're going to want to rebalance your portfolio to manage those certain allocations that you've established. Now, within those stocks as well, you can also have large cap, mid cap, small cap, right? And so you're going to want to have a mixture of all of these to be able to capitalize on the growth opportunities of small cap while also maintaining the safety net of the large cap stocks.
Great. Yeah. I mean, diversification right there in the example is between those large, medium, and small. And it helps to make sure that if one does poorly, the other one will help you write out those losses or vice versa. And at a macro level, though, it's worth mentioning that there is also diversification that we're not as familiar with, but it can include real estate, art, cryptocurrencies, international markets, even collectibles. We mainly talked about bonds and stocks because it's what we're familiar with, but you can diversify at a macro level in a lot larger way, and that's going to help you in market volatility in both normal and in extreme situations. And so that's what we want. We want to make sure that we understand diversification and that we're implementing it, just like we understand the opportunity and the risk and taking those calculated risks. Same thing with normal volatility, is understanding it and yet still investing, which however you feel is comfortable for you. And that's it. Accept that it's just a part of life and figure out what's best for you to be able to invest in short. Hopefully that was helpful, and if you have comments, please comment below. If you like the video, please like and follow. If you think this can help someone, please forward it along. It's why we do this. And if you want more information, please check out the book in reference specifically to mindset and how that can help in reference to surviving this type of fluctuations. You can also check out the website, cultumvita.com, or other videos that we have throughout social media. Anything else to add?
No.
All right. Well, thanks for watching. Until next time, stay curious, stay open, and stay true to you.